come at it necessarily from a Canadian perspective. And in fact, despite all the angst and anxiety, so far Canada has been let off the hooks to some extent because of the carve-outs for what's covered under USMCA, which is, basically, almost everything. Not steel, not aluminum. And there's still obviously some elements of the auto sector that will feel the pinch. But, when you consider what's happening India and in Switzerland and several Asian countries, Canada is not actually faring that badly on a relative basis. I'm looking at this mostly from, you could say, a global perspective. I would say from the U.S. economic perspective. I guess that what really rankles me is that you hear a lot of assumptions coming out of not just President Trump, but all his cabinet and all his economic staff that somehow these tariffs are not a tax increase, which in fact they have a similar impact to a tax increase because they're going to squeeze somebody in the United States. I guess what really I'm getting tired about are the assumptions being made that are being espoused as being gospel or truth. One of them, for example, and I hear this from Scott Bessent and from others, is that the foreign exporter is going to bear the complete brunt, which is not going to happen. And so far, they have taken part of the brunt, but not all of the brunt. You've got to ask yourself the question, that we're hearing that there's $150 billion of tariff revenues coming into Uncle Sam, and that's going to grow to at least $300 billion in an annual rate, if not more. Where does that money come from? It doesn't grow on trees. And it's not all going to come from foreign exporters cutting their prices to maintain their market share because they're going to go out of business. So who pays the duty? Like, do people sit back and say, geez, that's nice. I hear on CNBC or on Bloomberg or on Fox Business that we're just rolling in all this money into the U.S. Treasury to defray the big, beautiful bill. That money is not coming from the foreigner. That money is either coming from the domestic importer, because it's the domestic importer of notice that pays the customs duty to Uncle Sam. And the question is, along this chain, who then bears the brunt? And so this is actually a de facto tax increase. The question is, how much gets shared by the wholesaler / importer, by the manufacturer, and then by the consumer? And then you have to look product by product to see what are the various price demand elasticities. But to make the claim that the consumer comes out of this without paying higher prices is fantasy. But that's what's being promulgated. And then again, I hear the Treasury Secretary, who is renowned as being the superstar of the cabinet and has a stellar reputation, come out and say that, well, this is just going to be a one-off. Treat this as, he said, getting your driver's license fee. It's a one-off. But you see, I used to think it was going to be a one-off. But it's not going to be a one-off because it's not all happening at the same time. All these different countries are being treated totally differently. So you might have a deal with Japan and with UK, but all of a sudden we don't know what's going to happen with the EU. We're still in talks with China, what's going to happen there. We just had these punitive tariffs slapped onto India and to Switzerland. We don't know the extent to which the changes are going to be made to the USMCA, which is coming up. So what's happening here is that it's not a one-off. It's a drip, drip, drip. And it's going to be ongoing. This is what the Fed is facing. The Fed would like to believe this is going to be a one-off price shock. But it's like what happened with COVID. COVID was not a one-off supply chain disruption. All of a sudden, even after we got the vaccines, the next thing you know, China has one port city get 5 cases of COVID and they shut it down. And that had an ongoing implication for global supply chains. That's one of the reasons, among many others, why the inflation cycle lasted 18 months instead of 18 weeks. So this isn't a one-off. There's not a snowball's chance in hell that the consumer is not going to eat any of this at all. Now, I am of the view, by the way, that these price increases and the good side from the tariffs, and we haven't seen the whole thing play out yet, a lot of it will get eaten in margins because the labor market is weakening. We are seeing more slack emerge in the labor market that is going to compress nominal wages. And so we're left in a situation where if we get the inflation, the Fed can't cut rates. That's not very good. And then if we don't get the inflation with wages probably decelerating, we're going to get negative real income growth, and that's going to curtail consumer spending. You see, there is no good outcome here. I was very surprised that the president took on trade and tariffs as aggressively as he has. I thought it was going to be like it was in Trump 1.0, select trading partners, i.e. China, the true rip-off artist. It's not Canada. And by product. And of course, he's done that this time, but look at the size of these tariffs he's putting on. Now he's threatening humongous tariffs on semiconductors and on pharmaceuticals. The tariff rate, went to over 2% during Trump 1.0. And now when you look at the Yale Budget Lab numbers, it's going to be over 18% as it stands right now, which is a $2,400 annual hit to household budgets. But you see, the thing is that we're still in the early chapters here and people are extrapolating. And what I hear, and this is the third fallacy, is that, well, there's been no serious inflation yet from the tariffs. So, it's the classic Alfred E. Newman, like, what me worry? But the thing is that businesses in the United States had a lot of time to prepare. So that's why the import numbers spun out of control and we had a massive inventory bulge. And so the corporate sector has been working through those lower cost inventories. Even with that, you're starting to see goods inflation creep up. It's nice that we're seeing service sector disinflation provide an antidote. And we'll see how those two forces collide. But we're in the early stages yet. We haven't seen all these tariffs kick in yet. He just at midnight, slapped on those tariffs on roughly 90 different countries because we've just had all these reprieves. How can you say, on the one hand, well, we haven't seen the inflation yet? But yet all we've seen are these reprieves. They haven't even started yet to the full extent. Now, I am not a big inflationist, but let me just tell you something. I'm always looking for non-corroborating evidence to my base case view, and I'm always looking over my shoulder as to where my blind spot is. So I'm a little nervous, to tell you the truth, that there's going to be more of an inflation squeeze on incomes, and not just personal incomes, but profits, than what's being priced in right now. I think the Fed will be cutting rates. It's hard to say how quickly and by how much. I don't think that Powell is going to succumb to pressure, but then again, we'll get a new chairperson in May, and then we'll see what the reaction function is, because the Fed chairman has one vote, the most powerful vote, but still just one vote. It'll be interesting to see how that all plays out. But given that we still have tariff-related inflation risk, that has not gone away at all. The economy has to weaken a whole heck of a lot to get the Fed to ease policy aggressively, keeping in mind that there's still, roughly 150 basis points away from its own estimate of where neutral is. So there's a long road to hoe to get there. And so in the meantime, what we also confront is a Fed policy that, at least for the next, call it 6 to 9 months, is still going to be, fairly tight. Well, look, they cut 50 in September, then went another 50, and they were concerned about the labor market at that point. The policy was excessively tight. But remember that was before the tariff file was just fed a boatload of steroids. I mean, people like to talk about, well, the Fed did this and the Fed did that last fall. I don't think the Fed, I can speak for myself, thought that this was going to be the dominant agenda. And it complicates the inflation outlook. The Fed is obviously a government entity, despite its independence or its perceived independence, but they are a bunch of risk managers. They have to manage risks. And the inflation risk is higher now than it was then. And the Fed's primary concern with a 4.2% unemployment rate is whether the increase in prices, which they expect is going to happen. You see, they're not fooled by the fact that we haven't seen a more pernicious increase in inflation, because that's probably still lying ahead, because most of the tariffs haven't been implemented yet. And they're concerned with a fairly tight labor market, in their opinion. The labor market is showing some signs of cracks, but you can hardly say definitive signs of cracks from a supply-demand perspective. And that's the other thing that they're grappling with, is where's potential GDP growth right now, especially with the immigration outflows? Where is the unemployment rate benchmarked against the so-called natural rate of unemployment? And so the supply side of the economy, and primarily because of what's happening with immigration, that is also shifting. Well, people compare what the Fed was doing from September to December was in a completely different macro and risk environment. And I get frankly tired of when people say, well, look what the Fed did back then. Well, it was a different operating environment. And Powell has come out and said that definitively, that without the tariff file, they'd be cutting rates right now. They just don't buy into the White House view. Now, do you remember that the Fed is not really filled with politicians, but the White House is? And so the White House is going to give you a particular view on inflation. The Fed is giving you a different view, their view on inflation. They're the ones that control the monetary levers. I frankly don't quite understand why the president is pushing so hard for rate cuts prematurely in the face of tariff inflation risks. I'm sensitive to the view that this will get clogged up in the labor market, that companies may end up paying more of this cost than the consumer. To say the consumer's not going to pay anything, none of it shows up, is just, like I said, it's just ridiculous. And there's a lack of appreciation. It's interesting that the same people that are criticizing the Fed for taking its eye off the ball in 2021 and letting inflation fester, and criticizing the Fed for being slow to get ahead of the inflation curve, are the same ones complaining today that the Fed's not cutting interest rates into a different sort of potentially inflationary shock from these tariffs. So what I'm saying is that who can blame the Fed for taking it slow? And I don't quite understand why the president, who really got elected, we could say, border issues, immigration issues, there are lots of issues. But the cost of living was the number one issue. It was inflation that killed, I'm not going to say Biden or Harris. The Democrats were crushed by the inflation. And while fiscal policy played a big role, so did the Fed. The Democrats got crushed just as Jimmy Carter did when he presided over inflation. Inflation is a killer for your election prospects. Bill Clinton figured that out back in the 1990s. And so I'm a little surprised that we'd want to actually roll the dice from a political level on inflation. Once again, you have the stock market testing the highs, you have credit spreads at almost their tightest levels on record. There's no signs, when you're taking a look at all the speculation out there, that there's any signs of any liquidity problems. The Fed doesn't know where the neutral rate really is. They just know how far we are. Their posted level of the neutral interest rate is roughly 3%, but there's a lot of people think it's a bit higher because the policy is so tight. How come nothing's broken? Now, we can talk, me and you, about the non-farm payroll number and even the household survey. The labor market situation is deteriorating. It's uncertain as to how much of that is demand related or supply related. And that's what the Fed's grappling with, is that maybe, just maybe, even though they talk about restrictive monetary policy, it might not be as restrictive as a lot of people think. And after all, if it was restrictive, what's the stock market doing what it's doing? Why are credit spreads doing what they're doing? And that's a big mystery. And yet at the same time, I can understand. I remember back in December 2018 when Powell raised rates and the corporate bond market froze. And the stock market in December 2018 went down 20%. And at that December meeting, Powell basically said, we're not done yet. But they were done. And I wrote a report saying, are these guys tone deaf? The corporate bond market has frozen up. Spreads have basically widened out into orbit. But where, outside of the White House, where is this clamoring to cut interest rates so soon? And I'm still a bond bull. I still think the Fed will be cutting rates well in the next year. But I do respect the fact that as an institution, it is a risk manager. And I think it is a little nutty, unless the economy really collapses, unless we start to get the sort of stock market we had in 2022, or the sort of stock market we had back in the spring. The Fed's supposed to cut rates in this sort of environment? It just boggles the mind. And I don't even understand why at the political level it's so important right now to cut rates. Because why, as the president, would you want to risk? How could he be so certain? How can Stephen Myron and how can Besson and Lutnick be so convinced that there's no inflation risk from the tariffs? And so the Fed is definitely not sure. And let me tell you, when it comes time to cut rates, given their inflation concern, the economy is going to be weakening appreciably. So if you're hoping for lower rates, be careful what you hope for. It's a combination of the law of unintended consequences, which, by the way, is what an 18% de facto tariff rate is going to impinge on the economy. So I think the Fed's going to cut rates. And it's less about really inflation, which is a lagging indicator anyways. You remember when oil prices hit, they touched $150 in the summer of 2008. And everybody was talking about inflation. Well, tell me, what was the next move by the Fed? It was not to raise rates. By the way, I'm pretty sure that Richard Fisher, who is president of the Dallas Fed, was the only one who voted for a rate hike literally a month or two before Lehman collapsed because of the inflation risks from commodities. But the Fed cut rates into an inflation that didn't last, of course. But that's what we're talking about. I'm not saying, we have to have a financial collapse to get the Fed to cut. But what I'm saying is that the onus will have to be, in the circumstances, a much weaker economy than what we've seen to get the Fed to move off the sidelines.